Starbucks Corporation, SBUX, is currently trading at $99.96 USD, showing a significant intraday gain of 4.24 points, which is a 4.43% increase today, Wednesday, January 28, 2026. This sharp upward move comes immediately following the company's first quarter earnings release earlier this morning, and it's a classic example of why the headline numbers often lie in the world of professional finance. If you were looking at your ticker feed on the Robinhood app or checking your Fidelity brokerage account right when the numbers hit the tape, you might have seen a technical earnings miss and expected the worst. Starbucks reported non-GAAP earnings per share of 56 cents, which actually came in 3 cents lower than the 59 cents analysts were looking for. Normally, a bottom-line miss like that would send a retail giant into a tailspin, especially after a rough couple of years. But here is the insight that most people are missing. The quality of these earnings is fundamentally different from anything we have seen from this company in a long time. The market isn't just ignoring the miss, it is actively cheering for the way it happened. The stock is surging because for the first time in 8 consecutive quarters, Starbucks saw a 3% increase in comparable transactions in the U.S. market. That means more people are actually walking through the doors and placing orders, rather than the company just leaning on price hikes to inflate their numbers. This is a massive shift in momentum that suggests the Back to Starbucks strategy under Brian Niccol isn't just a marketing slogan, it is producing tangible foot traffic. The general belief around the coffee giant over the last year has been one of deep skepticism. Most investors on platforms like Interactive Brokers or SoFi Invest have been treating Starbucks as a legacy brand that lost its way, struggling with complex menus and a mobile ordering system that felt more like a chaotic logistics warehouse than a premium coffee experience. The expectation was that the turnaround would be a slow, painful grind, likely hampered by sticky inflation and a cooling consumer. However, the reality we are seeing today challenges that narrative entirely. While everyone was worried about the high cost of labor and coffee beans dragging down margins, which they did, leading to that EPS miss, the top-line growth is screaming that the brand still has immense pricing power and cultural relevance. Revenue hit $9.92 billion, comfortably beating the $9.87 billion consensus. This creates a fascinating tension for anyone involved in self-investing. Do you focus on the temporary margin squeeze caused by heavy investment in store staff and new equipment, or do you look at the 4% global comparable sales growth and realize the customer is coming back? When you compare this to the volatility we've seen recently in Nvidia stock or the unpredictable swings in Tesla stock, Starbucks is starting to look like a very different kind of opportunity for those using Schwab Intelligent portfolios or similar automated tools to balance their risk. Diving into the daily trading volume and institutional activity, it is clear that the smart money is repositioning. We saw significant volume spikes right at the open as institutional desks at places like Fidelity Wealth Management and major hedge funds reacted to the China news. Starbucks has finally made a move that many have been calling for by entering into a joint venture with Boyu Capital for its China retail operations. By selling a 60% stake in that business, they're essentially de-risking one of their most volatile segments while maintaining a 40% interest to capture future upside. This move alone has changed the risk profile for those holding the stock in an individual brokerage account. We noticed that leading up to this report, institutional sentiment was mixed, with some major players like Wellington Management reducing exposure, while others like Capital Research Global investors were adding to their positions. Today's price action suggests the buyers are winning the argument. The volume is tracking well above its 30-day average, indicating that this isn't just a retail-driven bounce on the Robinhood trading platform, but a structural reevaluation by professional managers who see the path to $110 or higher becoming much clearer. The macroeconomic pressure hasn't disappeared, of course. Inflation is still a factor, and the company explicitly mentioned that labor investments and higher coffee prices were the primary reasons for the margin contraction. They're spending heavily to put more baristas behind the counters during peak hours to fix the bottleneck problem that has plagued the mobile app experience. If you use the Fidelity mobile app or any other online investing tools to track sector momentum, you'll see that the broader restaurant industry is struggling with these same costs, yet Starbucks is one of the few that is successfully translating those investments into higher transaction counts. This is why the stock is outperforming the S&P 500 today. The reality is that Brian Niccol is applying the same playbook that worked at Chipotle, focusing on throughput and simplification. They've already cut about 30% of their U.S. menu offerings to speed up service. For someone looking for investment help or exploring different investing sites, this operational efficiency is a much more reliable indicator of long-term health than a single quarter's tax-impacted earnings figure. Let's step back and look at the business model to understand why this matters. Starbucks isn't just a coffee shop, it's a high-frequency retail habit backed by a massive digital ecosystem. They operate nearly 41,000 stores globally, with about half being company-operated. Their revenue comes from three main buckets: North America, which is the powerhouse; international, which is now becoming more of a licensed and joint venture play; and channel development, where they sell packaged coffee and ready-to-drink beverages through grocery stores. This diversified approach is why many investors include them alongside stalwarts like Apple stock in a long-term portfolio. However, the experience had become diluted. The current turnaround is about reclaiming that third-place feel while acknowledging that 70% of their business is now mobile, drive-through, or delivery. They're spending millions to redecorate stores and add more comfortable seating, literally the opposite of what most fast food chains are doing right now. They want you to stay longer, but they also want the person in the drive-thru to get their latte in under 3 minutes. It's a delicate balancing act, and the market is finally starting to believe they can pull it off. Looking at the future outlook, the company has finally reinstated its full-year 2026 guidance, which is a massive signal of confidence. They're calling for global same-sales growth of 3% or higher and an EPS range of $2.15 to $2.40. While the midpoint of that range is slightly below what some ultra-bullish analysts were hoping for, the fact that they're willing to put numbers on paper after a period of withdrawal shows that management feels they have found the floor. The catalysts for the rest of the year are numerous. We have the closing of the China deal in the spring, which should provide a significant cash infusion and a cleaner balance sheet. There is also the continued rollout of the Siren Craft system, which simplifies the way drinks are made, potentially boosting margins back up toward the 16 to 17% range by late 2026. For those using SoFi Active Investing or Interactive Brokers trading platforms, these are the milestones to watch. If they can maintain this transaction growth while slowly easing back on the aggressive labor spending as the new systems take hold, the earnings power of this company is going to be significantly higher than what is currently priced in. The risks, however, are real. We can't ignore the possibility of a further slowdown in consumer spending if the broader economy takes a hit. If the job market weakens, that $7 daily latte is often the first thing to go. There's also the geopolitical risk inherent in any company with a large international footprint, though the China joint venture helps mitigate that specifically for SBUX. Furthermore, competition is fierce. From high-end local roasters to value players like Dunkin' or even the growth of at-home premium brewing, Starbucks has to constantly justify its premium price point. This is why their loyalty program and mobile app are so critical. They have one of the most successful digital rewards programs in history, and leveraging that data to drive personalized offers is their best defense against a recession. If you're managing your own money through a self-investing strategy, you have to weigh these operational wins against the valuation. At a forward PE that is currently hovering around 27 to 27 times, it's not a cheap stock by traditional metrics, but it is trading at a discount compared to its historical 5-year average when the brand was firing on all cylinders. I want to hear your take on the current state of the coffee giant. Comment below with how many shares of Starbucks stock you are currently holding in your portfolio, or if you're waiting for a better entry point. Do you think the China joint venture is a smart move to protect the brand, or is it a sign of retreat? Engaging with these questions is how we get a better sense of the retail sentiment that drives so much of the price action we see on Robinhood and Fidelity. The community's perspective on the ground, actually visiting the stores and seeing the wait times, is often a leading indicator that the analysts on Wall Street miss until it shows up in the quarterly reports months later. To summarize the core of what we are seeing today, the tension between the